Hey everyone, it's Vincent. Welcome back to our monthly trucking market update. Today we're breaking down November 2025, a month that kicked off the holiday rush, but also brought a few curveballs across North America. As always, the goal here is simple. Give you clear, honest insight into what's happening in full truckload and LTL so you can make smarter supply chain decisions. Let's jump in, starting with Canada. November brought a mild cool down after October's stability. Overall, volumes held steady, supported by consistent demand in sectors like construction and energy. However, short-haul activity dipped slightly in the eastern provinces. On the rate side, full truckload base rates softened by about 1.2% compared to October, largely due to easing capacity in the prairies and a drop in diesel prices around 1.65 Canadian per liter. Rates sit still at 0.9% higher year over year, mainly reflecting inflated carrier operating costs. LTL rates followed a similar trend, down 0.8% month over month, but still firm on longer routes where capacity stayed balanced. Heading into December, rates are expected to stabilize as holiday e-commerce demand peaks. We're projecting full truckload volumes to climb 3 to 5% in major urban centers like Toronto and Vancouver. Looking into early 2026, expect a 1 to 2% rate increase if carrier consolidations continue and fuel prices rebound. Something to watch closely when planning your budgets. Cross-border lanes between Canada and the US remained a mixed picture in November, influenced by tariffs and seasonal import flows. Let's talk northbound. Heading into Canada, it was stronger than expected, up 2.5% from October, fueled by electronics and consumer goods restocking for the holidays. Rates rose 0.7%, though fuel surcharges eased as diesel prices dipped to around 3.60 USD per gallon. Now southbound, from Canada to the US, volumes moderated by 1.8% as agricultural exports slowed post-harvest, leading to a 0.4% dip in rates. Overall, capacity felt slightly looser than in October, giving shippers a bit more negotiating leverage on non-urgent freight. Through December, northbound lanes could see rates rise another 2 to 3% as peak holiday demand strains capacity and drivers take year-end time off. Southbound traffic may stay flat or dip 1%, though new tariff adjustments could add 2 to 4% to costs on machinery and auto parts. Pro tip: if you're moving high-value goods, now is the time to double-check your customs paperwork to avoid costly delays, especially for parcels. We've seen several clients recently face issues with tariff calculations, so stay proactive and keep in contact with your customs brokers. In the US, the domestic market showed early signs of tightening as November wrapped up. Truckload volumes slipped 1.3% from October amid softer manufacturing output, but spot rates rose 1.5% month over month, particularly for dry van and reefer lanes in the Midwest and Southeast. LTL remained a standout, with rates up 2.1% from October and an impressive 9.5% year-over-year increase as carriers pushed through cost adjustments despite muted volumes. Flatbed activity held steady, supported by infrastructure projects in the Southwest. Looking ahead into December and Q1 2026, the market is expected to firm further. Truckload rates could climb 3 to 4% as smaller carriers exit and capacity tightens. The holiday surge is likely to lift volumes 4 to 6%, especially in retail-heavy regions like California and Texas. If you haven't already, lock in capacity early to avoid premium rate spikes. That's your November 2025 trucking market snapshot. Steady in parts, tightening in others, with opportunities for those who will stay ahead. If this sparks any questions or you want me to chat about it and how it impacts your lanes, feel free to reach out. Thanks for watching, and I'll see you next month for December's update. Stay safe on the roads.